Warren Buffett, the Oracle of Omaha, the greatest investor of all time. His name is synonymous with wealth, wisdom, and patience. Buffett's rise from modest beginnings to amass a multi-billion-dollar fortune is the stuff of legend. But how did he do it? In this iconic interview from the 1980s, Buffett gives us a glimpse into his investing philosophy and the timeless principles behind his phenomenal success. Warren Buffett that emerges as grounded, ethical, and insightful. He teaches us that rationality, not complexity, is the key. Success comes not from speculation or clever maneuvers, but from discipline, patience, and fundamentally sound principles. This interview shows how Buffett's framework can be adapted by the average investor. There are valuable lessons here for experienced market watchers and novices alike. Now let's reveal the key insights from the interview. Number 1. Adopting a business mindset. Right at the outset, Buffett establishes that he approaches stocks as a pragmatic businessperson assessing a private business for acquisition. He bought his stakes in great companies for the ultra-long term. As he puts it, if we buy a stock today, we approach it as if we own the entire company, and we're going to hold it essentially forever. This gives him an almost unfair durable advantage over speculators and traders caught up in monthly, quarterly, or annual stock price fluctuations. Number 2. Having a wide margin of safety. The bedrock of Buffett's investing approach is buying simple, predictable businesses with a Fort Knox balance sheet, i.e. excellent fundamentals, high return on equity, low debt to equity, strong free cash flows, robust margins, etc., and at a price far lower than the intrinsic value with a huge margin of safety. In simple terms, Buffett wants to buy $1 worth of high-quality business assets by paying just 50 cents whenever the opportunity presents itself through market volatility. He has no interest in trying to extract the last ounce of profit through clever bargaining, deception, or speculation. He's laser-focused on paying an extremely good price for an extremely good business. That's the heart of the Buffett way. Number 3. Staying in your circle of competence. Buffett stresses that investors must only focus on simple businesses that align tightly within their circle of competence, ones they thoroughly understand inside out. As he explains, you have to figure out what your natural aptitudes and personality align to. If you play games where other people have the skills, temperament, or advantage, and you don't, you're overwhelmingly likely to lose out. So Warren avoids capital-intensive businesses and complex technology stocks and sticks to time-tested businesses with enduring economics that squarely match his abilities: consumer brands, insurance, banking, media, and industrials. Number 4. Betting on America's dynamism. Despite periodic bouts of fear or hysteria around American decline, Buffett declares he is 100% convinced that America will be far better 10, 20, and 30 years from now, pointing to its unique track record of overcoming external challenges, civil liberty, demographic dynamism, and culture entrepreneurship as reasons to be structurally optimistic. As proof, he commits almost the entire Buffett portfolio to stalwart, all-weather American businesses. Number 5. Thinking independently. At calling his mentor Ben Graham, Buffett emphasizes like no other the need to think rationally, patiently, and above all, independently. To ignore or filter out the noisy short-term chatter, predictions, and hysteria from Wall Street professionals who are often just making money on people making knee-jerk decisions. He cautions against using fluffy, complex financial models and technical jargon as a substitute for old-fashioned independent thinking, common sense, humility, and emotional discipline. In his view, investing is not some sort of holy war that requires advanced degrees or complex thinking. The basics are simple, though not easy to implement consistently. In addition to these core tenets, the interview covers many other aspects of Buffett's framework. He discusses why temperament is just as important as intelligence for investing success, how most people overestimate the short-term impact but underestimate the long-term impact of key events, analogous to how throwing more analysts at a problem doesn't necessarily solve it better, why he doesn't split Berkshire's stock or pay dividends despite pressure. He reinvests profits if the value is there, how macroeconomic forecasts by experts have little value for investors, why talent and integrity, more than genius, are key to managerial success, how consistency and discipline compound over decades, why diversification is mandatory in areas you are uncertain about, how important it is to constantly update your investment process, and why companies with enduring competitive advantage deserve premium valuations. What is striking overall is Buffett's grounded wisdom and clarity of thought. He cuts through the noise effortlessly. He speaks with humility about the limits of his knowledge and stresses eternal principles over specific forecasts. This mindset is the perfect antidote to the complex models and irrational exuberance that often lead Wall Street astray. No wonder generations of investors have found inspiration, guidance, and sanity in Buffett's words. His success proves these timeless ideas work extraordinarily well in practice too. As Buffett says, the basic ideas of investing are to look at stocks as businesses, be patient, use common sense, and do your homework. It's very simple, but that's pretty much it. So if we absorb the wisdom from this interview and cultivate discipline, patience, and sound business principles, we too can become successful investors. Not overnight, not without effort, but steadily and rationally like the master himself. So focus on building rock-solid foundations, controlling emotions, and developing fundamentally sound investment habits. Learn diligently from the oracle's wisdom shared in interviews like this. Stay rational, optimistic, and ethical. Ignore the complexity and chaos. As we conclude this timeless journey through Warren Buffett's insights from that iconic 1980s interview on investing, one thing becomes abundantly clear. The principles of financial wisdom are not bound by time. They transcend eras. Buffett's pearls of investment wisdom, shared with unwavering clarity and simplicity, remain as relevant today as they were back then. In an age where market dynamics are ever evolving and economic landscapes are in constant flux, Buffett's steadfast commitment to the fundamentals of value investing stands as a beacon of guidance. If you found value in this exploration, don't forget to hit that like button, subscribe for more insightful content,